Welcome to episode 30 of Accessible Finance, where we demystify personal financial topics and answer your questions so you leave saying, I get it now. I'm Eric
And
Johns.
I'm Rachel John.
Let's dive in.
All right. So, given how close we are to that April 15th deadline that is looming for everybody, we've decided to kind of walk through a tax return, kind of line by line, um, as best we can.
All right.
I'm gonna reel him in, so we won't go into as much depth as he probably wants. But if you have your tax return filed or you're in the process of filing your tax return, it would be really helpful to have your 1040 out to follow
In
along with
front of
us.
you, right?
Yes.
Because you wanted me to cite the references like line one.
Yes, I do. Yes.
Okay.
As specific as you can.
She's
Yes.
the boss, guys. So we do this.
Yeah.
She says it, we do it. So,
I'm gonna hold on to that.
okay, fair enough.
Yeah.
I might regret this later. So, so what we're doing, guys, we're trying to give you guys just some overview of what financial planners would look at on your return.
Right.
Okay. So like we get your return, this is the kind of stuff
What
we're
do we
looking
do
at.
with it?
All
Yeah.
right. Why do we even want your tax return?
hmm
Well,
I think
here
it's
goes.
important to allude to a previous episode that we had where oftentimes, we did an episode about how to assess if your CPA is good or not. And a lot of times the misconception is based
Right.
upon your
Magnitude
refund
of the
or
return.
correct. And so hopefully this will help illuminate why that is in and of itself.
Spoiler alert, that's one of the things we look
Yeah.
for. High return, not so great. Yeah, we'll
Yes,
adjust your W-4.
correct.
Okay, so we get a client's return. First thing we look at, filing status. Is it single,
Yeah.
married filing jointly, married filing separately, head of household,
Yeah.
qualified surviving spouse? We just look for that, okay? Filing status, it's important. All right. We're then going to look for blind or over 65 because you get a larger standard deduction.
Conditional, yeah.
All right.
And then we'll look for dependents.
Correct. We're going to look
Mhm,
for your dependents, make sure everything's listed there.
mhm.
And if you have any, dependents that we hadn't discussed before, we're talking about it.
Right. Or if there's a dependent that's out there that has not been claimed, then we'll talk about that too.
Right. So things that we're obviously going to be looking at the wages. That's
Mhm.
important. We're going to be looking at things like box 2A is tax exempt interest. Why will we look at that? Well, because if you've got tax exempt interest, you most likely on a 1040 have municipal bond income.
Yeah.
All right. So if you've got that and you're not in the highest tax bracket, we're going to talk about it. And more specifically, we're going to tell you probably shouldn't. Okay. So unless you're very near the highest tax brackets or you're just fundamentally opposed to paying a single dollar to the government, you want to just your whole goal is not to maximize your income, but to just pay the least to the government. You're
Correct.
making that stand. Okay, great. You can make that stand. We just want to be intentional about it. So anyway, we're looking at box 2A.
Yeah. In addition to 2A, I think it's important to note the possibility of like AMT or the alternative minimum tax where that could end up being taxable.
If it's private purpose muni bonds,
Mhm.
sure. Yes. That would be we would most likely, yeah. All right, fair enough. We're gonna look at the
We would
AMT
have
form for
something to
that.
say about it. Correct.
Taxable interest, we want to see how much interest you're generating from your accounts. This is a fun one. Little anecdote. Recently, was
Mhm.
looking at a client's tax return. And I was like, so where's your, 1099 from JP Morgan, your
Mhm.
1099 INT from like one of your JP Morgan savings accounts? And the client was like, I don't know that I got one. And I was like, wait a second. Like I know what you have in the account. You have
Yeah.
over
You
10 grand
definitely
on the
have some
account.
stuff.
Over 10 grand on the account, you would expect
Correct.
all it has to generate is $10 or more, and they're required to issue a 1099 INT. Right. So I'm like, there's no way this account with interest rates at five and a quarter aren't
Doesn't
paying
have it.
you, at least $50 or so. Nothing. It generated zero savings. So we realized it when we were filing the tax return
Yeah.
that wait a second, this account is not where my money should be because it's not paying me
It's not
anything.
doing anything. That's a
It's
really
not
great point.
working. Right. So anyway, we want to look at that taxable
Yeah.
interest. Right.
It's also one of the areas I think that people are most likely to make a mistake, particularly as they've gone the route of electronic statements. If you've opted out of papers, they might send you an email. If you're anything like me, you probably have thousands of those.
Mhm.
So it's easy to get lost in the fray. So unless you already know very, very well what accounts you have and you're going to look for those um, 1099s, it's super easy to miss, and you don't want to end up getting your return flagged because it doesn't match something that is sent to the government from
Right. This
JP
is
Morgan.
also going to tell us how much you're saving. This is going to tell us kind of where some of your investable assets are. If this number is huge and for example, your qualified and ordinary dividends are low, it tells us that you've got a ton of bonds or interest producing assets
hmm
in taxable accounts, which is not where we would typically advocate holding those. Right. So we know based just on that line, again, line 2B, that we should probably reconsider, at least we should at least have a conversation about it. So that's the thing. We're just looking to have conversations about these things that
Right.
might be anomalous, or just, a little bit off, or we're thinking we want to at least clarify.
Mhm.
All right,
All right, so
next,
we're looking at 1, 2, 3.
3A, 3B. All right, what is that? What did 3A is qualified dividends.
Mhm.
3B is ordinary dividends,
What qualifies something?
holding it for holding it for a while,
Yeah.
let's say. Okay, holding it for a while.
Okay.
All right. Try it. Try it. I'm trying to be good.
You're being good.
Should I do it anyway? No, all right.
No.
Um,
But yes, that's essentially the differentiation is the length of time that you've held the asset.
Correct. So if qualified are very low, so again, qualified is a subset of ordinary. So the ordinary is going to be your qualified plus your
It's everything.
non-qualified,
Yeah.
all right? And then your qualified is going to be a smaller number that like 2A will always be a small, I'm sorry, 3A will be a smaller number than 3B.
Correct.
Okay.
It's a portion of the
So you want it to be, it should be a substantial portion of it. It's almost never going to be 100%. There are reasons for that, but just accept that it's never going to be 100. All right. I'm sorry. I'm trying to be good. We're staying high level
All
here.
right.
Trying not to get granular. All
Yeah.
right. So 3A is going to be less than 3B.
Yep.
We want it to be about, call it like over 70%. All right. We want it to be pretty high. We would love everything to be qualified because it's taxed at a more favorable rate.
That's what I was gonna
Okay.
lead you to next.
Qualified is
Exactly.
taxed at your capital gains tax rate, which is at all times more favorable than your ordinary income tax rate.
It's essentially an incentive to hold on to your assets for longer.
Right. Um, Next line, 4A versus 4B. All right, those are IRA distributions or Roth conversions. Okay.
Mm-hmm.
So if you've taken distributions from your IRA, there's going to be something in 4A, and then the taxable amount will show up as the same amount if all of it's taxable. Okay. So I mean, obviously, if there's something there and you're under, 59 and a half or not retired or subject to RMDs, we want to talk about that. Like,
Yeah.
how'd you decide on the number? What was it for? Like, what kind of considerations did you have here? All right. Obviously, we talk about 6A and 6B if you're taking Social Security. I'm sorry, Social Security
They
benefits.
might wonder what happened to line 5.
What is line 5? Pensions and annuities? We're going to talk about that if there's anything there.
Okay.
We need to know about pensions and annuities.
We need to make sure they know you
Ordinary
didn't
income,
skip it on
usually
purpose.
ordinary income taxable
Mhm.
amounts, right? 7's interesting. So capital gain or loss, it's going to be from Schedule D. But we want to know that this is interesting because if you ever see like negative 3,000 in line 7, that's the maximum amount of loss that you can use to offset ordinary income in a given year. And you
And
guys
those
are like, those
losses.
are
Yeah.
cute numbers and this is all wonderful. I didn't understand
Exactly.
anything you just said. I get it. But if that number's 3,000, negative 3,000, it typically means that you have what's called a capital loss carryover. And why that's important is if you happen to prepare your returns yourself, or if you go to a different preparer next year, you
Mhm.
need to remember what that number is so they can use it in the following years. You
I
can
think
carry it forward for your lifetime.
And I think it's really important to know, like when you're looking at your tax return, sometimes seeing negative numbers can be really, really jarring. In this case, having a negative number there could actually
That's
be
great.
quite a favorable
Love it.
tax planning strategy.
Tax
Yeah.
loss harvesting is great. So we
Correct.
love everybody to have negative 3,000 there every year. That'd be
Correct.
awesome.
Exactly. We would gladly have three
Yeah,
negative
I'll
3,000.
take it. I will take
Uh,
it.
so yeah, exactly. All right.
Line 8 is gonna be from Schedule 1. It's usually if you have, like a sole
Miscellaneous
proprietorship
income.
or if you have a business. So if you have a Schedule C or if
Mhm.
you have a K-1 that you're getting a partnership you participate in or a S corp. Anyway, sorry, we're looking at it, but I mean, we're looking at most of the lines on the return, to be honest with you.
We are. I mean,
But
we're looking at everything
right,
because we want to make sure that there's nothing that sticks out as this should be here, but it's not, or it shouldn't be here, but it is.
correct.
But again, like unless you own a business or are affiliated with something, you know, aside from those W-2s, you're not really seeing anything
Right. So we'll talk about a little bit about, sorry, where are we? Oh,
there. Nine.
AGI.
Yeah.
AGI, line 11. Everybody's gonna talk. We're gonna talk about this a lot, right?
Yeah.
Because this is
Where
gonna be a
you
number
spend
that
most of your time. Yeah.
yeah, you're gonna talk about your AGI because that's gonna be where a lot of your deductions that you're eligible for
Yeah.
are gonna be based on line 11. Okay, so that's the number you're trying to increase or decrease, and that's gonna determine your deductions, or the deductibility of certain, credits or deductions that you can take on your return.
Yeah. Now, this right here, I think, is where people assume that a CPA can work magic. But the reality is
I
that
mean,
the
it's
law is
just
the law. It is what
you're
it
just
is.
adding and subtracting the lines above it, right? So there's not a
Correct.
whole lot that they can really do. They're just reporting things on your
Right.
return. Then you're going to take usually the standard deduction or itemizing. It's important to look for well, charitable deductions we want to see. We want to see where charitable deductions are on the return. That's going to be important because if you're taking charitable deductions, right? If you're taking charitable deductions and you are not itemizing deductions, which means you do not file a Schedule A with your return, and
Which
you are
means that by default, you're taking the standard deduction.
correct. Most people
Mhm.
don't. Most people take the standard deduction and they
Correct.
do not itemize. I
They've
think
made it harder
it's
and
a
harder to do.
well, they just kept increasing the
Correct.
standard deduction so that it's no longer advantageous to itemize, which is great for everybody,
Mhm.
honestly, because it was very tedious to try to keep receipts for everything and then try to
Correct.
quantify it and itemize. That was a pain. Nobody wanted to do that, so they just kept increasing the standard deduction, and that's what we're working with right now. But if you are charitably inclined and you are maybe you're giving like a couple $1,000s a year, a few $1,000s a year, maybe five or even $10,000 a year, and you're still not able to itemize. One of the we want to know that because the better way to do that is to give a lump sum so that you can itemize.
Right.
Okay, so you give a lump sum at one point in time to what's called a
Correct.
donor advised fund, and then you slowly dole it out from there.
Right. So the
So you
idea
can
is
still
essentially
gift. If
like
I wanted to give
if
10K a
that's what I
year,
was just gonna
all
say.
right, then I could gift like 100K to a donor advised fund, take a
Right.
huge deduction on my return. I
Right.
could itemize and take a 100K deduction,
Right.
right?
But if I was doing it $10,000 a year
I
for
never get to
perpetuity,
itemize. I never get any deduction at
correct.
all.
Correct.
You will always have lower net dollars if you make charitable contributions. This is another like fallacy that sorry, we're derailed, but we're there. So
You
we're
derailed.
I'm sorry.
You did this.
Um a lot of people think like, oh, he has just incredibly low taxes and he doesn't pay any taxes because he gives a lot of things to charity. Giving to charity
It's
will
not automatically
well, you lose 100% of the dollars you've given to charity, right?
correct.
So like you will always be better off even if my tax rate is like 99%. I'm still 1% better off than giving all of those dollars to charity. Does that make
Correct.
sense?
Now, it is important though to acknowledge the like non-quantifiable
Oh, for sure.
benefits of
Absolutely.
donating to a cause that is near and dear to your heart. So
Absolutely.
I
Highly
want to
recommend it. Go
be
for it.
very clear that
Yeah, we're not like anti
not at all. But
charitable.
the idea is that if you're being charitable,
Right.
we want to put you in a better
Right. We want to take
financial
advantage of
position
that
to be able
monetarily.
to continue being charitable.
Mhm.
So, like that donor advised fund and things like that are underutilized tools. So that is definitely something we would look at. Now, while we're hanging out in the deductions, I think it's important to just kind of mention some of the most common deductions that people take, like HSA contributions,
Okay.
right?
Sure.
Um,
Usually gonna be reflected in your W-2, which means you're not
mhm,
gonna have to like actively go and do
put it
anything
on the line.
else for that.
Um, you've also got like student loan interest if you still got loans outstanding, right?
Correct.
You've got
Correct.
alimony if that's you.
Taxable alimony is only deductible if it's fine. Divorce was finalized before 2019, so 2018 or prior.
Interesting.
Yeah,
Wow, so if
I
we got
learned
to
something.
wait, so if we got divorced now and you paid me alimony,
It's not deductible to me, not taxable to you.
yeah, okay,
Right. It used to be
interesting,
deductible by me and taxable to you. Now it's
interesting.
just
Okay, I didn't
nobody
know the
cares about it.
changes.
I'll have already paid tax on the income. It'll be after tax dollars.
Oh, okay, okay.
So next, you're looking at Schedule B. We're looking at interest and ordinary dividends. Where did it come from? And then it's notable if we have like interest from U.S. government bonds, we want to make note of that because on the state return, it's deductible.
Now, Schedule B is reported on what line on the 1040?
Schedule B is not a line.
Well, next up we would have line 12. So I'm trying
Oh,
to help them.
I skipped way ahead.
Correct.
I'm
So
sorry.
it's not
I turned some
next.
pages.
That's what I'm saying.
That's a fair point.
Correct.
That's a very fair
Like
point.
the schedules happen after all of our line items, so we want to make sure we're going through all the lines because if you're following
Correct.
up with your 1040,
Yeah, that's a good
you're
point.
probably
I just completely bailed on that whole idea.
I'm very confused as to what you think we're doing.
um, so
Okay.
let's look at. I'm sorry. We'll go to 16. We'll go to 16. All right.
Well, I think that it's just important to reiterate that all of 12 goes back to we take our itemized deduction, standard deduction, compare and take the bigger one.
Yeah, line 12 is almost always going to say your standard deduction amount.
Correct.
I think it's like 98% of America itemizes.
Yes.
I mean, no longer itemizes. They
The
take the standard
numbers,
deduction, something like that.
yes.
It's huge. It's a
Particularly if
ginormous
you
number.
are married, filing jointly, or
Right.
something where that's really favorable.
Right.
Yeah.
Um, yeah, if we look at the tax and credits section, right? So 16 through 24, if we're looking
Mhm.
at those lines, we want to see what the tax is, but more importantly, we want to see what the I'm sorry, we want to see the payments, right? So we want to see what you've withheld. We'd actually jump down, okay,
To line what?
34,
Mm-hmm.
and we see if that number is small,
Yeah.
large, or potentially, you know,
So this is the number that you're
we jump to
probably
37 and
looking
see what you
at
got.
to assess whether or not your CPA is awesome.
Right. We want to
Um,
look at 34 and 37, not for that. We want
right.
if 34 is high, if line 34, which is your refund amount, if that is high, particularly over like five or $10,000,
Yeah.
something needs to change. You
And
should
we've done
withhold
a
less money.
podcast about this previously
Right. Because you're
where
making interest-free loans to
to the
the federal
government.
government.
Correct. And so
If that's your intention, congratulations, you succeeded admirably. If it is not, let's make some changes.
that's one kind of charity.
Yeah, exactly. But it's probably not the kind that most people think about.
Okay, it's probably not intentional.
Sure.
So again, like there are a variety of investments that you can have with that $5,000 or $10,000 refund that you would have where the returns would be something more than nothing.
Mhm.
So
Right. If you didn't overpay and you underpaid,
yeah.
you might have something that you owe on line 37. I also would like to make the point that, and we made this in the previous episode, it's not bad to owe money.
If
It's
it's
letting
intentional.
them make an interest-free loan to you.
Yeah.
As long as you're under the safe harbor, that is technically optimal. Does that make sense? So, like, if let's
Mhm.
assume, real quick scenario, let's assume that my tax liability for last year
Yeah.
was $1,000.
Okay.
Okay. Let's also assume the safe harbor for most people that make $1,000, all right,
Right.
is going to be I need to withhold $1,000.
Yeah.
I need to withhold 100% of my prior year's tax liability.
Okay.
Okay. Prior year's taxes owed, prior year, not taxes owed, I guess, tax liability.
Yeah.
Okay. Last year's line 37.
Yeah.
All right. So I withhold $1,000, but this year's tax liability, I sold 8 houses and I
Yeah.
made $10 million. My tax liability, let's say it's $500,000. Okay. I now owe my line 37 for this year
Mhm.
is going to say $500,000. Okay. I can pay them 1,000 and take that, what is it, 499 interest-free
And
loan.
invest
And
it.
I just owe it by
Mhm.
April 15th. Okay.
Correct. Now I have a question for you, Eric. If April 15th happened, I filed my tax return, I have my amount,
Mhm.
right? Um,
499,000 is what we're talking? Or are we going with a different example here?
yeah, 499,000 is fine.
Okay.
Well, let's do the year with the thousand, the year right prior.
Got it.
Okay. So let's say that I have the thousand. Um, I go through life, all of these amazing things have happened. I know my tax bill is going to be a lot higher.
Okay.
How high it is, I, as a general, individual, um, probably has no idea. And I really don't want sticker shock when I find out that it's $500,000. So, what steps can I take throughout the year to kind of hone in on what my liability is going to be? Because it doesn't feel great. It doesn't feel like an interest-free loan from the government if I'm not
If
on
you're
the
losing
front
sleep
end.
at night too,
Well,
yeah.
if I'm not on the front end aware of the fact that
It's gotta be
at
too.
the end of the line, I
Yeah.
have to pay X
Right.
amount.
Right.
So I don't want to be surprised. Like I want to
Sure.
know exactly kind of what I'm borrowing
Yeah, no,
essentially.
that's completely
Um,
reasonable.
so how do I do that? How do I make sure that I do know that before I fill out my 1040 and get surprised?
Just ask me.
Okay,
I'm
well,
kidding.
how do you know?
Um,
Like, what do you do?
we use, tax planning software that tells us, but if you wanted to, if you were inclined to do it on your own, and you're not involved, if you're not working with a planner, then you can probably log into Free Tax USA and start inputting your data,
Mm.
right? I honestly, to be full disclosure, have not tried doing this. I mean, I know I
Proactively, right?
correct. Like,
We've
I
done it to
prepare
file
the
our
return when
returns.
you can do it. I don't expect that there's any kind of limitation for when you can log in and start plugging in numbers, but so I would generally advocate
Like to
doing
do
that.
like what if scenarios, are you
Correct, but
talking?
if that doesn't work, then you can use I'm sure that I know that for a fact that you can use TurboTax if you're willing to pay them, right? So you can
Yeah.
use any kind of tax planning software that you're comfortable with and just plug your numbers and see what it tells you, right?
Mhm.
Like, for Free Tax USA, it's the top of the screen. It'll say, like, federal tax, like, negative whatever, negative 499,000. And then you're like, "Whoa, alright, I'm gonna
Now,
owe it."
I do think it's important to point out that when you're working with, now again, not all financial planners are created equally, but when you're working with a good financial planner, tax awareness and discussions are happening throughout the year. It's not, oh, it's March, let's get ready to file your tax return, give me all your papers.
Mhm.
So at all points in time, I mean, we send monthly things to our clients. I think at all points in time, you're looking to make sure that the most tax advantaged decisions are happening and that the client is fully aware of, or that you would be fully aware of, you know, if we make decision A, this is the like end result, or this is the consequence.
Mhm.
Because like you were saying, if somebody was to lose sleep at night, even though objectively an interest-free loan from the government is awesome, um, then that just might not be the right decision for them. And that's
Absolutely agree.
okay.
Absolutely agree. It's about quality of life for you, right? Like if your life's made miserable by some of these optimal
Correct.
plays, don't make
Correct.
the optimal plays.
And also some
We do
people
that. Everybody does that every day.
correct. Some people genuinely cannot see extra money in their bank account and not spend it. So like if you're somebody who's not going to be able to like have the money ready to fork over because you're like, "Oh, I have this extra money. I'm gonna go buy a boat." And I
Right,
go,
right, right.
"Don't do
Then you're
that.
gonna dig yourself a huge hole
Don't
because
be that
taxes and
person."
penalties are not good,
Correct.
right?
Correct.
Um,
Agreed.
I guess I should say penalties and fees. Penalties and interest are not good,
Right,
right?
because the tax, you already
Taxes,
know what you're
it's
paying.
there, but
It
you
is what
know,
it
the
is.
penalties and interest potentially not there. So anyway, when
Right.
we jump down, we talked about the refund or the tax liability that you're going to be paying. Now we look at the schedules, right? So Schedule B is
Right.
interest and ordinary dividends. This is going to talk about the lines that we had in the front of the 1040. So you can see a breakdown of what you actually put on the front of your 1040. What was interest is line, what is it, 4B, I want to say?
Here, I'm gonna pull it.
You just had it.
Yes.
Um, sorry. Front of the 1040
Yeah.
is that's 2B. So taxable interest is 2B. That's going to be
Yeah.
on
Blue
Schedule
Box
B.
is 3.
And then ordinary dividends is 3B. That's also reflected on Schedule B. Okay. So we're looking at Schedule B. You know, we're just interested. This just kind of will show us how many accounts you have, like if they're
Absolutely.
scattered, right?
Accounts
If
that
it,
you have.
it might say, every bank in the
Mhm.
New Orleans metropolitan area, maybe we don't need that, right? Or at least not savings accounts at every one of them.
Correct. And we do have a lot of clients who come to us that are just like, please
Yeah,
help me
consolidate
consolidate.
this. I don't even know what's happening.
Correct.
Big time is if we see a Schedule C, right? That's a big deal.
Yeah.
There are a ton of planning opportunities if you own your own business. Okay.
Correct.
And a lot of people are thinking, like, well, I don't have like a storefront and, I'm not stocking inventory. No,
Hmm.
no, no, no. We're talking any kind of a business. Like if
Yeah.
you take in income and you are engaged in an activity for profit with a profit motive, then you possibly own your own business and we should have a conversation about it.
Well, and I think that there's been a huge shift in the interest of the general public
Side hustles.
of yes, a
Yeah.
thousand
No,
percent.
100%.
I mean, in my profession, most everyone that I'm working with does precisely that. And the
Mhm.
thing is, I mean, even if it's just a summertime like time thing, it's still a separate activity. Some people, especially during COVID, I think we saw a lot of rise in like Etsy participation and
Mhm.
really artsy, crafty things. All of those things are generating income of some kind.
Right.
And so there's a real conversation to be had about not just doing it for $5 here or there, but actually setting up a business.
Correct.
Um,
Correct. So Schedule C, big deal if you have
yeah,
one. Lots to talk about. But we
yeah,
won't dive into it because most people don't.
yeah.
Schedule D is going to talk about capital gains and losses.
We
That
do a
is
whole episode on this schedule
Schedule
C.
C. We could,
Yeah,
but I
I'm
mean,
making a note.
I don't want to bore everyone, right? But
Well, we won't do it now,
if
but I
it's
do think,
if it's something that's interesting, please let us know and we'll dive in. All right, we
yeah,
will.
schedule C in business. I'm making a note. All right. Sorry.
Um, so Schedule D is going to kind of clarify a little bit of what's going on the front of the 1040 again. It's going to show you the actual securities that were sold. Well, actually, it's not. Schedule D has a breakdown, which is what is it? 89.49. So 89.49 is going to actually give you a breakdown of what happened on the Schedule D. Again, sorry, we're getting super granular, but Schedule D is the capital gains and losses. That's if you've held something like held a security for a length of time and then disposed of that security, right? You're going to have a gain or a loss usually. Okay. Um, and then you're going to pay taxes at either ordinary income
Hmm.
if it's short-term capital gain or loss, or capital gains rate if it's long-term capital gains or loss.
Depending
We're going to net
upon
this amount.
what financial institution you're working with, you might not even know what that is. Like if
Right.
you're
They're going to
working
usually
with
send you
a
like a 1090 composite
correct.
1099 that's going to combine all the things. This would be on 1099B,
Yeah.
but you don't have to know any of that. That's not all that important. What's important is when we look at this, we want to see what the net amount is. We want to see really, this will
Mhm.
tell us kind of too, well, the 8949 will definitely tell us how much wheeling and dealing is going on. Like, what is the turnover in your accounts? Like, and are
That's
you
a big
intending
thing.
it to be that high.
Yeah.
Some people might make a couple trades themselves and they might be kind of aware of it. Some people might have already, handed it off to their financial advisor or something, and then they get this form and they see like 150
I've seen
transactions. And they're like,
eons.
what just happened to me?
Yes. I mean,
Like,
side
why is all this
story,
happening?
eons ago, there was a client I was working with that had like hundreds of transactions every tax year, and none of them did anything meaningful other than to show the client falsely, like, look at all the things I'm doing. And so it's really important to know that the volume of trades is irrelevant.
Right. Yeah,
It just
absolutely.
is.
Absolutely. So, I mean, we're gonna look at all the forms. So there's
Mhm.
2441 is child and you don't need the form number, but there's gonna be a child dependent
It's good if they
care.
have their tax return and they're
Uh,
following
if
along.
you're if you're looking, if you're scrolling through, on free tax
Usually
USA,
it's hard than just gloss over the
right?
numbers.
But
Um,
the tax credits that most people are going to qualify for, at least those that are in our cohort that we interact with, are going to
mhm.
be child and dependent care expenses,
Yeah.
which are any expenses that are paid for your kids to enable you and your spouse to work. Okay. So you need earned income for you and your spouse. You need like wages for you and your spouse. They have to
Correct.
both be working. You can't take it if one of the spouses is
Right, you
sitting at
can't
home
stay home and
and
then get
just
a credit
neglecting to
for
watch your kids or whatever,
right.
right? So you can list things like aftercare, summer camps,
Mhm.
anything that's like that, like any
All of
kind of
that.
like nannies that are watching them during the day. So
Okay, but some people who are not like some people who pay to go to private school or Catholic school may have an inquiry about does my tuition
no,
correct?
no, it does not.
So exactly, because like that is a legal requirement that children are going to school, but they are not
Mhm.
legally required to go to camp or to aftercare.
Right,
But those are things that enable you as an
right.
individual to work.
And so you want to keep track of those expenses at least until you have 3,000 for one child or 6,000 for two or more child or children.
Two or more child.
Two or more child. Right. So you want to keep track of that, and then you can get 20%
So if I have
of the
two
amount that you
kids
have.
and if I have 8 kids, I have to claim the same number,
The
the same
maximum is
amount.
$6,000.
Okay.
So you're gonna get 20% of that or $1,200 credit if you
Hmm.
had the full maximum of $6,000 of expenses to
Correct.
substantiate. If you have one child, the maximum is $3,000,
Right.
right?
So we're talking
So you only got
600.
$600 is your maximum credit. All right.
Perfect.
Then you're gonna have the child tax credit. So you're like, wait, you just talked about that. You just told me I could get 20% of 6,000. Isn't that the child tax credit? No, no, no. There's a child and dependent care credit.
Right.
And
So
then
you're taking care of them.
right. And then there is a child tax credit.
Okay. And we just
Child
yank
tax credit,
it.
they just need to be alive, um, and under what is it, 16, I wanna say?
Yeah, that sounds right. Um, it's got to be on there. But yes, it's um an acknowledgement. Yep, under 17.
Under
That's right.
17, so 16.
0.9999.
Right.
Yeah. And so what does that credit look like, Eric?
What does it look like? Oh,
Is it
sorry,
a
2,000
dollar?
2,000 per child,
Yeah.
and it has a phase out, right? So that's when we talked about AGI, when we
For
said
income. Yeah.
when your adjusted gross why is your adjusted gross income important? It's for things like that, for
So
phase outs of these credits.
the dependent care one basically capped it at 2 kids. But for this tax credit, does it apply to each child? Like
Each
if I
child,
have 8 kids, it would apply to all 8.
16 grand.
Okay. Granted, 16 grand is the max that I could get if my income was low enough to get the max.
Correct. Exactly correct.
I'm with you.
Okay, and then at that point, I mean, we look at other schedules that they have, but if they don't, then Schedule E is something we didn't talk about. Schedule E is typically if you have like rental real estate, um, rent receives or other kinds of expenses, they could be on
Mhm.
Schedule E. So we're gonna want to see that. We're gonna want to see mostly to see how you are expensing those rents, right? And what your participation is in that
Mhm.
property. There's a ton of rules around rental real estate
What's active
participation.
yeah,
There's
exactly.
there's non-active participation,
Yeah.
there's active participation, and then there's material participation. And we are not going to talk about it right now. Just know that there's three and there's stuff to take about.
It could be valuable to do an episode that dives into not just like necessarily Schedule C, but like any of the schedules that may be pertinent to
Happy to
say
do it.
vehicles.
If
Yeah. If it's something that's interesting.
yeah,
But
if it's interesting, we'll do
it's
it.
definitely a niche section.
Yeah. Well, we're
Um
definitely going long with this one, but if we do we want
that's
to
okay.
do we want
That's
to dive
okay.
into Louisiana real quick? There's only a couple things, or do you want to just
Are there
wrap
only
it
a
up?
couple things?
Nothing's ever quick with me, so we should wrap it.
Well, okay. What if our next one we can touch on the Louisiana first, and then we can have an addendum at the end that touches on the schedules.
You got it.
But yeah,
It's interesting.
so yeah, I mean, I think just understanding that something that seems very complex, I think that the 1040 looks as complicated as it possibly can. There's lines and words everywhere. So hopefully this helped kind of um, take something that seems very complicated, simplified it a bit in lots of words, but still, I I think that it's just important to know that there's a lot of information that's in there. And so
Mhm.
whatever financial person you are working with should be looking at that like as soon as it is available to project ahead for the next year.
Correct. Yeah, it's incredibly valuable.
Yeah,
There's a lot of information there, so make sure you know what it is and how to read it.
correct.
All right. If you enjoyed today's episode, please follow the show. And if you have any topics you'd like discussed or financial problems you'd like solved, reach out to us at podcast@equilibriumfp.com or visit the website, equilibriumfp.com.
Till
Thanks.
next time.